Welcome to the latest episode of Quest for Twice. This is a busy week for me because quite a few companies reported their most recent quarterly results, especially Atkore, Emerson, and Hubbell in the electric segment. So I will start with reviewing the Atkore Q1 performance first. Just a reminder that Atkore's fiscal year ends at the end of September. Its sales increased 14% from 1 year ago, driven by 19% increase in its electric segment. It's also its largest segment. Its EBITDA margin increased to almost 35% from 21% in 1 year ago, also in the electric segment. That's driven by very constrained industry supply with the rising market demand due to the very hot residential housing market. It's the other segment, infrastructure segment, formerly known as mechanical segment. Margin declined from 15% to about 11.5% because of the steel input costs increased, and Atkore did not have sufficient time to pass that input cost to its customers. But because its electric segment performance was so dominant, and its performance was also very good. So its overall EBITDA increased 76% from 1 year ago, driven by almost double of the EBITDA in its electrical segment. And with the Q1 under its belt, the management raised its 2021 EBITDA estimate from $350 million to $400 million. So it's a 30% increase compared to the estimate given in November 2020. And the management wanted to manage the investors' expectation, so they also gave an early estimate, a very early estimate of a 2022 EBITDA around $400 million. So that's less than $450 million they expect in 2021. And that's because they expect the current tight market in its electric segment will begin to ease in the summer of 2021. Then it will become more normalized in 2022. Its 2021 adjusted earning per share was also raised to $5.80 from $4.10 estimated in November of last year. And it generated quite a bit of cash given that the big EBITDA increase. So it paid down debt by $40 million and bought back shares by $35 million. And because of its forecast of a very strong cash flow in the rest of 2021, the board also authorized additional buyback of $100 million in 2021 and 2022. So overall, very strong business performance by Atkore. Now let's switch gear and take a look at Emerson. As a reminder that Emerson also has two segments. One is automation solutions. The other one is commercial and residential solutions. In the commercial and residential solutions, Emerson makes products for HVAC system as well as power tools. The reason it's interesting to look at Emerson is because Emerson gave a good context of what's going on with the overall economy. So in this chart is a historical plot of a trailing 3 month order compared to 1 year ago. So the 0% is in the middle, means then there was no growth or contraction compared to 1 year ago. And there are three lines in this graph. The thick blue line is the overall Emerson performance, and the green line is the automation solution, and the other thin blue line is the commercial residential solutions. So clearly we see a V-shaped recovery from Emerson's perspective. The V was reached in the summer of 2020. Then its commercial residential solutions rebounded very significantly. The automation solution lagged behind. So the overall thick blue line had a very classic V shape. What's interesting is comparing its just past quarter performance with its guidance given in November of last year. So in November, it forecast a order contraction of minus 15% to minus 5% overall. And there was a blue dot in that dotted box. So that was a guidance given in November last year. So we can see the actual performance of the trailing 3 month orders were actually better than expected than the guidance given in November. The thick blue line reached the top of that dotted box in above the October and December timeframe. So that's higher than the midpoint. That's the dot in that box. So as a result, now Emerson forecast the trailing 3 month order will reach about a neutral point, no increase or no decline either at the end of February compared to 1 year ago. And keeping in mind that at the end of February, there was a minimum impact on the economy from the COVID pandemic. So it's it sees the business and the general economy is recovering at a very rapid pace. And that's led by its commercial and residential business related to the residential housing market, as well as the HVAC market. Although Emerson experienced a slight sales decline in the most recent quarter compared to 1 year ago, its EBITDA margin actually improved quite a bit, 290 base percentage points and 210 base percentage points for its automation and commercial and residential solutions. So as a result, despite the slight underlying sales decline, its EBIT, earning before interest and tax, increased 20%, driven by the margin improvement, which basically means it reduced its cost quite a bit. And with the minimum change in the sales and a better mix, since its commercial residential solutions has a better margin, so its EBIT increased 20%. So it's a very good performance. Maybe not as outstanding as Atkore, but it's a pretty good business. On the other hand, Hubbell, which is a supplier for electrical and electronic products for the electric segment and the power utility segment, It suffered 7% organic sales decline from 1 year ago, and most importantly, its margin also declined 60 base percentage points compared to 1 year ago. So its performance can be characterized as a little disappointing. It's tabulated below as a benchmark to compare with the Atkore and Emerson. So I've updated the table at the bottom of this page to show the three companies' financial and valuation metrics. So Emerson is expect 2021's sales to be slightly down from 2019. That's pre-pandemic, but it's recovering fairly well. And compared to Atkore, it actually expected a 9% increase from 2019. And Hubbell also expected 3% down compared to 2019 in its sales. They still make a pretty good EBITDA margin and return on invested capital. They have minimum movement in their long-term debts. I mentioned before that Atkore reduced its debt by $40 million in the last quarter. Atkore experienced significant price appreciation in the last 3 months. The last time I checked, its price was about $52 per share. So give it a market cap about $2.5 billion. So despite its large increase in its stock price, we can look at its valuation metric of EV over the 2021 EBITDA. It's about 7.8. If we use 2022 EBITDA guidance of $400 million given by its management, then this ratio will go up by about 10%. So we will have about 8.5. So I'm comparing that with about 13.7 for Emerson and Hubbell. I would say Atkore is still undervalued, and it has a pretty strong growth prospect. And one can argue that with such a good strong growth, it should actually have a higher EV to EBITDA ratio compared to Emerson and Hubbell. Lastly, I want to document my most recent portfolio update. At beginning of this week, I sold some Berkshire Hathaway stock. It's not that I don't like the stock anymore, but I want to increase my cash holding in my portfolio to 5%. Why? Because I found the recent news about the COVID variants a bit concerning. There are variants in South Africa, in Brazil, and a new UK variant. That's not the most prevalent variant in UK. This new variant in UK is a E484K variant. It's a belief that they would reduce the effectiveness of vaccines, including the solid data related to the effectiveness of vaccines made by Johnson & Johnson and Novavax. And also, there was a fairly recent resurgence of COVID-19 in the city of Manaus, Brazil. Despite the high percentage of people who had antibody from the previous infection, the study suggests that almost 76% of its population had antibody from from previous infection. Nevertheless, uh, nevertheless, and it's suffering resurgence of COVID-19. So it's most likely can be attributed to the latest variant is different from the previous variant, so that the infection from previous variant have limited protection against the new variant. So Moderna and Pfizer vaccines may need another booster. So besides the current two shots regime, they may need another booster to protect the people with have been vaccinated against new variants. However, because both mRNA vaccines are difficult to distribute due to the requirements related to the cold storage, so I expect that their distribution will be a bit challenging. So as a result, if the new variants become widely spread and turns out that the mRNA vaccines are less effective against these new variants, I believe the economy recovery will be delayed. So I'm currently considering the Fan Plus stocks as a defensive play. I haven't bought any yet, but if there is a significant pullback in Nasdaq, I likely will establish some small positions in those technology, in those major technology companies as a defensive play, because they benefit from the staying at home trend that people will continue to practice if the vaccine are less effective against the new variants. So this is the end of this new episode. Thanks for watching, and hope to see you next time. Happy investing.